Here's a stat that might shock you. 73% of homeowners are either underinsured or paying too much for coverage they don't understand. That could mean tens of thousands in uncovered losses or thousands in unnecessary premiums every single year. I'm talking about people who could have protected their $400,000 home with intelligent choices, but didn't. My neighbor Sarah learned this the hard way. Her basement flooded in 2024. She thought her homeowner's policy covered water damage. It didn't. The repair bill, $28,000. She had just enough liquid savings to survive it, but most people don't. Here's what most YouTube videos won't tell you. Home insurance isn't complicated once you understand 3 core principles. In the next 11 minutes, you're going to learn exactly what insurance companies are betting you don't know. By the end, you'll have a concrete action plan that could save you hundreds per year while actually increasing your real protection. Let's break this down. Most people lump all home insurance into one bucket. That's your first mistake. There are actually 3 distinct layers of coverage, and you need to understand what each one does. First, dwelling coverage. This is the structure itself. Your walls, roof, foundation, built-in cabinets, anything attached to the house. When insurers quote you a policy, this is the number they lead with. A typical 2,000 square foot house in 2026 runs between $150,000 to $300,000 in dwelling coverage, depending on where you live and material costs. Second, personal property coverage. This is your stuff inside the house. Furniture, electronics, clothes, kitchen appliances, everything you'd take if the house burned down. Most policies cover 50 to 70% of your dwelling coverage for personal property. Here's where people mess up. They insure their house for $250,000, but their personal property limit is capped at $125,000. If you lose everything, you're leaving money on the table. Third, liability coverage. This is legal protection. If someone gets injured on your property and sues you, or if your kid's baseball flies through a neighbor's window, this covers your legal defense and damages. Minimum coverage is usually $100,000 to $300,000, but that's dangerously low in 2026. A single medical lawsuit could exceed that in minutes. You want at least $300,000 to $500,000 in liability. The 3-layer system matters because you optimize each one independently. Now, the question every homeowner asks, how much dwelling coverage do I actually need? Here's where most people guess wrong. They look at their mortgage balance or what they paid for the house in 2015. Both are terrible benchmarks. What matters is, what would it cost to completely rebuild this house today in 2026, not the current market value? These numbers are wildly different. Your house might be worth $350,000 on the market, but cost $450,000 to rebuild because materials and labor have increased 30% since 2020. That's why insurance companies use reconstruction cost, not market value. Here's the calculation. Take your square footage and multiply by your area's per square foot rebuild cost. In 2026, that ranges from $150 per square foot in rural areas to $350 per square foot in major cities. So a 2,000 square foot house in Denver costs roughly $250,000 to rebuild. In San Francisco, try $700,000. Most insurers let you calculate this on their websites, or you can hire a professional home appraiser for $300 to $500 for exact numbers. The critical part, you should insure for at least 80% of reconstruction cost, preferably 100%. Why 80%? Because inflation adjustment clauses in modern policies automatically raise your limit annually. But here's the trap. If you insure for less than 80% and have a claim, insurers use something called the coinsurance penalty, which can reduce your payout by 30% or more. I've seen policies where a homeowner insured for only $150,000 when they should have had $300,000, then lost $80,000 in coverage on a major claim. Don't be that person. Use an online calculator or your agent. It takes 15 minutes. The deductible is the single biggest lever for controlling your premium, and it's where you can save substantial money if you understand the math. A deductible is what you pay out of pocket before insurance kicks in. Standard options are $250, $500, $1,500, and sometimes $5,000. Here's how people usually decide. They pick the cheapest premium, which means the lowest deductible. That feels safe. But it's financially backwards. Let me show you the actual numbers. Let's say you're comparing a $250 deductible versus a $1,000 deductible on a $200,000 home. The $250 deductible policy costs $1,200 per year. The $1,000 deductible costs $900 per year. That's $300 in annual savings. Over 10 years, you'd save $3,000 by choosing the higher deductible. Now here's the key insight. Most homeowners file maybe one claim every 10 years, if that. So that $3,000 savings is very likely to accumulate untouched. The math only breaks if you're filing a claim every year, which would be unusual. A smart framework. If you have 6 months of emergency savings, you can safely handle a $1,000 deductible. If you're uncertain about your liquid cash, stay at $500. Never go lower than $500 in 2026. The premium savings aren't worth the false sense of security. And if you have genuine financial cushion, consider that $2,500 deductible, which saves you another $200 to $400 per year. Over a lifetime, that compounds into real money. The psychology here matters too. A higher deductible makes you think twice before filing small claims. You become more careful. Lower deductibles tempt people to claim minor damage, which raises your rates and can get you flagged as a high-risk customer. It's a hidden cost most people don't calculate. Let's talk about the 5 strategies that actually work to lower your premiums without sacrificing coverage. First, bundling. If you have home and auto insurance, combining them with the same company typically saves 10 to 25% on both policies. We're talking $200 to $600 per year easy. Most people don't optimize this because they bought policies separately. Call your auto insurer and ask for a home quote. Takes one phone call. Second, security upgrades. This one pays immediate dividends. Installing a monitored alarm system, deadbolts, and storm shutters can lower your premium by 5% to 15%. Some insurers specifically advertise discounts for smart home security systems. A $500 alarm system pays for itself in discounts within 3 to 4 years. Then you keep saving. Third, claims-free discount. Go without filing a claim for 3 to 5 years, and insurers reward you with 10% to 20% discounts. This is why the deductible strategy matters. It keeps you from filing small claims that reset this timer. Fourth, home improvements. New roof, updated electrical system, modern HVAC. Insurers love this because it reduces risk. Document these improvements with photos and receipts, then contact your insurer. Discounts range from 5% to 10%. Fifth, annual quote shopping. This is the big one people avoid but shouldn't. Get new quotes every 2 years. I guarantee you'll find better rates. Insurance companies rely on inertia. They know most customers won't switch. A new customer shopping around averages 20% cheaper than a customer who's been with the same company for 5 years. Spend 2 hours getting 3 quotes. Very likely you'll save $300 to $1,000 annually. That's $150 per hour of your time. No job pays better. Now here's where most people get hurt after they've bought insurance: the claim itself. Insurance companies are legally required to pay valid claims, but they have enormous incentive to question, delay, or minimize them. Understanding what kills claims saves you thousands. Red flag number 1, not documenting the damage properly. After a loss, take photographs of everything. Every angle, every detail. Even parts that seem obviously damaged. Video walkthrough too. The insurer will hire an adjuster, but your documentation is your evidence. People skip this and later can't prove the extent of damage. Red flag 2. Waiting too long to report. Your policy requires prompt notification, usually within 30 days. If you wait months, the insurer will question your timeline and whether the damage was pre-existing. Report immediately. Red flag 3. Hiring unlicensed contractors before the adjuster approves. You need the insurance company to authorize repairs. If you repair first and ask for reimbursement, they can deny it by claiming the repairs weren't necessary or were overpriced. Always get pre-approval. Red flag 4. Verbal conversations without documentation. Every conversation with your insurance company should be in writing, email, or certified mail. He said, she said arguments get decided against policyholders. Get names, dates, and email confirmations. Red flag 5. Accepting the first adjuster's estimate without pushback. Adjusters work for the insurance company, not you. If you believe their damage assessment is too low, hire a public adjuster or engineer to counter-assess. Yes, it costs $1,000 to $3,000, but on a $40,000 claim where the insurer underpaid by $15,000, it's a no-brainer ROI. The last red flag: misrepresenting your home during application. Did you convert your garage to a living space without permits? Own a dog labeled a dangerous breed? Run a home business? These can void your entire policy if undisclosed. Be completely honest on your application. It's legally binding. Let's build your concrete action plan for the next 30 days. This is what you're going to do, step by step, to optimize your situation. Week 1. Audit your current policy. Dig up your homeowner's insurance documents. Write down dwelling coverage amount, personal property limit, liability limit, deductible, and annual premium. If you can't find it, call your agent or log into your insurance company's website. Takes 15 minutes. Now calculate what your dwelling coverage should be using the square footage times rebuild cost method we discussed. Compare it to what you actually have. Is it enough? If not, note the gap. Week 2. Contact your insurer about a coverage review. Tell them you want to discuss raising your dwelling coverage to match reconstruction costs. Ask them specifically about available discounts, bundling, security systems, claims-free status, home improvements. Get quotes in writing. Week 3. Shop for rates. Use comparison sites like the Zebra, NerdWallet, or Insurify to get 3 to 5 competing quotes. Make sure you're comparing identical coverage, same dwelling amount, same deductible, same liability limits. This takes 1 to 2 hours but saves significant money. Week 4. Make your decision and implement. Pick the best option based on price and reputation, switch if needed, and set a calendar reminder for 1 year out to repeat this process. If you're switching, ensure there's no gap in coverage. New policy should start the day your old one ends. That's it. 30 days. 1 phone call per week. You'll almost certainly save money, increase your actual protection, and have peace of mind that you're not overpaying. Do this annually, and you'll stay on the right side of insurance economics. You've learned the 3 coverage types, how to calculate real coverage needs, why deductible strategy matters more than people think, 5 concrete ways to lower premiums, and the claim mistakes that cost homeowners thousands. Most importantly, you now understand that home insurance isn't about buying the cheapest policy, it's about buying the right coverage at the lowest price. That combination takes maybe 5 hours per year and saves thousands. If you're still undecided about any of this, the simplest first step is this: get 1 quote. Just 1. Use an online tool or call an agent. See what your house actually costs to insure at proper coverage levels. That number alone will open your eyes to whether you're currently protected or exposed. If you found value in this video, please like and subscribe. Next week, we're covering life insurance mistakes, specifically why term insurance is exploding in popularity and why whole life might be a trap for your situation. We're also diving into how much life insurance you actually need based on your financial obligations, not just generic rules of thumb. Click the subscribe button so you don't miss that, because it could affect hundreds of thousands of dollars in your financial plan. Thanks for watching. Let's get you properly insured and stop leaving money on the table.